again. Hey guys, I've just gotta say it. This market today is unbearable. Hey, what was that? Hey everybody, welcome to Mind Tide, where we talk tech and personal finance. I'm your host Kyle, and today we're going to talk about the difference between a bear market and a bull market. It's referring to a condition of time in an overall market or individual securities within a market dealing with what is and or what is expected. It's not just the prices of stock, but also the psyche of buyers and sellers in the market. And there's not really a universal metric that defines either one. So, what is a bear market? When you hear bearish, think pessimistic. It's typically a period where market indices values decline by 20% or more over 2 or more months. It's a period where there are more sellers than buyers in the market, driving stock prices down. This is long-term in a secular bear market, which is thankfully not what we have because that can last for decades. It's where market trends downward over time, thus consisting of larger bear markets than bull markets. A cyclical bear market can last for a few weeks or a few years, which is typically what we see. A bear market can be induced by a weak or stagnant economy, which can be indicated by higher unemployment rates, leading to less disposable income, aka people ain't buying stuff, which leads to companies producing less and thus becoming less profitable. But most people don't recognize that this is happening until the government steps in like,
yo, we're reducing interest rates,
which is aimed at encouraging borrowing and spending, but often is happening at a time when investors will react negatively. Then more people are like,
yo, this is real. Let me bop on over and sell my shares before prices go down even more and I lose even more money.
This is called capitulation, aka panic selling. But let's be real here. Stop it. Just stop it. Half the time people are looking at their total investment account value and not what they've actually invested out of pocket into the market. You're technically only losing if your account values fall below your initial investments. What you're losing is potential gains that you could have made if you had sold your shares earlier, but you didn't. So now you're better off riding the wave and buying even more shares while stock prices are low until the market is increasing again. Which leads me to what is a bull market. It's just the opposite. When you hear bullish, think optimistic. This is long-term in a secular bull market, which is what we've had for the past 100 years. It's where a market trends upward over time, thus consisting of larger bull markets than bear markets. This is a period where stock prices rise by 20% because they came off an unbearable 20% decline. The length of this time is in a way dependent on the time elapsed between the last and the next bear market. It's a period where there are more buyers than sellers in the market, driving stock prices up. A bull market can be induced by a strong or strengthening economy, which can be indicated by lower unemployment rates, leading to more disposable income, aka people buying stuff, which leads to companies producing more and thus becoming more profitable. Then people start feeling good. They start walking around. They want some walking around money. Then the GDP strengthens. Then the government steps in like,
yo, we raising interest rates because people can afford to pay more now and we can raise our reserves.
Then more people are like,
yo, this is real. Let me bop on over and see how much money I've made off of my shares. Oh, you want to buy at that price? Funny. We only going up from here, baby.
This is called arrogance. And you should sell when you're comfortable with how much you've made so far, but we're not doing that. Although it's what inexperienced investors do. But why a bull and a bear were selected, we don't really know the origin, but it's been accepted as reality, because it makes sense, I guess. I think it's because the stock market is believed to have started hundreds of years ago where people gathered and traded securities under a tree. Since they were already outside, cats was like, hey, look at that bull over there. Nah, look at that bear over there. Yo, that's what this is like. Animals attack with where they can deliver most of their power. A bull, when attacking, is putting its head down and thrusting upwards with its horns. Thus, a bull market is a market that is growing and trending positively. A bear market, when attacking, is putting its paws up high and striking down with its body weight. Thus, a bear market is a market that is shrinking and trending negatively. The circle of economics is much like the circle of life. There's a time to be born and a time to die. Just like there's a time to invest and a time to sell. It's all part of the process. So don't panic sell or FOMO buy every time you see some volatility that makes the back of your neck hair rise. Because if you're that uncomfortable, then maybe you failed at rule number 1, which is assessing what you're comfortable with losing. Wait, dang it, that's not this video. I'll get back to that later. I'm sorry. But it is important to note that the majority of the drastic one-day spikes, positive or negative, have happened within a bear market. One reason is because as things are on a decline, the government intervenes. Feds will cut interest rates, which make people more bullish for a moment, then things decrease more. The White House announces a stimulus package and people become bullish again for another moment. Then the next day reality hits like, nah, I'm taking that. Unless you're a literal day trader, aka a broker, the stock market is for long-term investing. Consider buying and holding onto your shares for years to come. That's why it's important to carefully select whom and what you want to invest in and not do it flippantly. But your best option is to make consistent investments at intervals you're comfortable with, and naturally you will ride the waves of volatility in the market. Some things you will buy high and some things you will buy low, but you'll have that yin and yang and the peace of not trying to time the market all the time. Because nobody knows when the market will bottom or peak. You have a 50-50 chance of stocks going up or down day to day, but long-term stock values tend to trend up. Again, like the past 100 years. As always, thank you for watching. Like, share with a homie, leave comments, and subscribe if you want to grow with me. I am Kyle. This is Montad. Deuces.
Is the elephant heavy? I'm coming back, baby.